This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Wall Street whiplash. The Dow blows past 26,000. But the rally fell apart, and by the closing bell, the market suffered its biggest turnaround in 2 years. Breaking up? It's hard to do, but the CEO of one of America's biggest conglomerates says there's a chance it could happen. The road ahead. Americans are driving off with new cars, but there are questions about how long the good times will last. Those stories and more tonight on Nightly Business Report for Tuesday, January 16th. Good evening, everyone, and welcome. I'm Sue Herrera. Tyler Matheson is off tonight. It was a day that started like no other, but then a reversal of fortune. Stocks surged out of the gate at the opening bell, piercing through 26,000. It seemed like the rally was entering a new phase, but then a turn and then a collapse. The rally was no more. The indexes turned negative. And when the closing bell rang, the Dow swung nearly 400 points in total, its biggest reversal in nearly 2 years. At the close, the Dow Jones Industrial Average fell 10 points to 25,792. The Nasdaq was off 37, and the S&P 500 dropped 9. The wild day was a head-scratcher. So Bob Pisani watched the action from the New York Stock Exchange and explains what happened.
It was a roller coaster ride for the markets, with the Dow opening at a new record of 26,000, but shortly after that milestone, with the Dow up 283 points in the middle of the morning, investors just seemed to lose interest, and the markets drifted lower into the afternoon, with the Dow ending fractionally negative. What happened? Well, some brought up fears of government shutdown later on, but for most traders, the markets had reached such lofty levels that it was just logical to take profits, and you can't blame them for feeling this way. Much of the initial rally was fueled by earnings optimism, that was real, and tax cuts, and that was very real. But it's already led to a handful of companies raising their full year estimates. There's also a little bit of this FOMO going on, fear of missing out on the rally. So we saw exchange-traded funds with very strong inflows in the last week, and I mean into everything, into the U.S. stock market, into the European stock market, into emerging market stocks, into everything. And remember that old trader saw, when everybody wants in, traders get a little bit nervous. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So let's talk a little bit more about why the market reversed earlier and what that could mean for this long-running bull. Joining us is Hugh Johnson, Chairman and Chief Investment Officer at Hugh Johnson Advisors. Good to see you again, Hugh. Welcome back.
Nice to be with you, Sue. Thanks very much. Nice to be with you.
I guess we shouldn't be surprised, given the velocity of the last couple of weeks with this market. I mean, it was a record run in terms of time, from 25,000 to 26,000 on the Dow.
Yeah, you know, it's probably time for a breather. I think anybody that's a professional investor that's been at this for a long time, as I have, you just ordinarily expect some sort of a breather or some sort of a pullback. It's common sense to expect that, and quite frankly, the decline today might be setting the stage for a little bit deeper of a correction phase in this market. We came a long way, very far, very fast, not only in the first 2 weeks of this year, but obviously in the last 2 years. So let's just say time for a breather with some time out.
But it wouldn't derail the overall bull run in the market. Would it be that healthy correction that we've been looking for so long?
Yeah, I think it'd be a healthy correction, and I don't think it derails the bull market. When I ask myself, is this stock market, economic, interest rate cycle still alive? And I look at the performance of the markets over a longer period of time, and if I look at the performance of important economic variables, they say pretty clearly that we have further to go in the current cycle. In addition to that, Sue, I would simply say that I think earnings will be strong enough. I'll answer the question, which I think is the big question. I think earnings will be strong enough in 2018 to justify or support stocks at current levels and even higher.
What about interest rates? Because if indeed we start to get a little bit more wage pressure or inflation, we've been watching the oil market for the last couple of weeks move higher. And some say that that's the inflation the Fed has been looking for or waiting for, and therefore they might raise interest rates a little bit more aggressively. Can this market withstand that?
For a while, we can. For a while, I think the rise in interest rates that I suspect is coming will not be enough to derail the bull market or offset the good news from very strong earnings that are helped along so much by the reduction in corporate taxes or the tax reform. But eventually we're going to get to this point, and you've seen this before and I've seen this before, where interest rates are simply going to be too high, and the interest rates or the rise in interest rates, the level of interest rates, will more than offset the good news on earnings, and then we'll start the end of the cycle or the end of the bull market and the start of something that might not be very pretty to watch from the point of view of the economy in a recession.
Very quickly before we have to go, Hugh, where are you still finding value in a market that just pierced through the 26,000 mark intraday?
It's hard to find value, but I do find value, and I find value in the stuff that really works, which are the economically sensitive sectors of the market: materials, consumer discretionary, industrials, and still, if you look hard, some technology stocks, which I think still have room on the upside. So I think stay with the bull market. Maybe later in the year, we might have to shift to defense, utilities, and telecommunications, but not yet. It's too early for that.
Hugh Johnson with Hugh Johnson Advisors. Well, Merck was the best performing Dow component today. A late-stage drug trial showed that Merck's blockbuster drug Keytruda, when used with 2 chemotherapy drugs, was successful as a first-line treatment for lung cancer. The early results indicated that that drug cocktail could help cancer patients live longer and stop the disease from advancing. That stock of Merck rose nearly 6% in trading today. And the second best performing Dow stock today was UnitedHealth. That company topped earnings expectations and raised its profit outlook for the year by more than 16% due to the corporate tax cut. The insurer also said that it plans to speed up investments in technology that it hopes will cut customer costs. UnitedHealth is the largest U.S. health insurer and the first to report fourth quarter profits. The stock rose more than 1.5% on the trading session. Then there was General Electric. It was the worst performing stock on the blue chip index today, falling nearly 3%. This after the company announced a $6 billion setback, and the CEO said something that was once thought unthinkable. He is thinking about a breakup. Morgan Brennan has our story.
It could mark the end of an era, the potential breakup of General Electric. On a call with analysts today, CEO and Chairman John Flannery said he's seriously considering it.
As I look at the company and continue to evolve along this continuum, I believe there could be different structures that can achieve all of those objectives and that we need to examine those. I would categorize it as an examination of options, and it's the kind of thing that could result in many, many different permutations, including separately traded assets really in any one of our units, if that's what made sense.
Since taking the helm last summer, Flannery has repeatedly stated everything is on the table as he tries to turn the struggling blue chip company around. But today marked the first time the new CEO has explicitly said that a total breakup is possible, with GE's core industrial businesses, power, aviation, and healthcare, potentially on tap to be spun out. The comments coming on the heels of, quote, deeply disappointing news that GE Capital will incur a $6 billion charge for its legacy insurance portfolio in the fourth quarter and must set aside another $15 billion over the next 7 years. Quarterly results will be reported next Wednesday, but sources say more details on a prospective breakup could come this spring. And while it has not been fully decided whether such a move will actually occur, the possibility marks a huge shift for the Dow's oldest member, and for a corporation that has been, for more than a century, America's most famous industrial conglomerate. For Nightly Business Report, I'm Morgan Brennan.
And as Morgan just told us, GE, as we know it, may soon see some major changes. So what could a potential split up mean for the ailing blue chip and its stock? Here to discuss that is John Inch, a senior analyst covering the multi-industry and electrical equipment sectors at Deutsche Bank. John, thanks so much for joining us.
Thanks for having me, Sue.
What is your reaction to the possibility of a breakup at GE?
Well, first, I think GE is facing an incredible squeeze in terms of its cash flow, its business operations. It had to cut its dividend in half. And quite frankly, this company is very complicated. I'm extremely skeptical that a breakup, certainly cleanly, would not be possible. I think there could be things they could do to perhaps try and unlock some value. The problem is GE, even though the stock has come off so much, it's really not inexpensive. And so one of the reasons you would theoretically break a company like this up is to unlock value. We just don't think there's a lot of value to unlock. In fact, the stock seems to be, the pieces seem to be priced fairly efficiently. And meantime, what people seem to forget is you can't just separate, the aviation or the healthcare businesses. These are the important cash generators of the company at a time when GE very much needs cash flow. It's backstopping all of GE Capital's bonds, over $100 billion of bonds. There would be tremendous tax leakage from separating the company, and there could be a whole host of other issues as well.
What are the options that you think Mr. Flannery could put in place to remedy the situation at GE? And we should note, I believe you have a sell rating on the stock. Is that correct?
I do, correct. So this is not a straightforward fix. The issues that GE is facing today have been up to decades in the making, long before John Flannery. John Flannery inherited this mess, and I think they're sort of on the right track in terms of trying to streamline the portfolio and simplify it. But an outright bust up, I think, is it's just going to take a long time, Sue. I don't think there's any quick fix for GE or what ails it, and they're just going to have to work through their challenges, whether they be in power or other issues as well. It's just going to take a long time. Some
investors held it for the dividend. As you mentioned, they have slashed the dividend. Do they need to eliminate the dividend completely?
Well, if you look at the cash flows, and you referenced earlier in your piece the $15 billion of insurance, this is just one segment of GE Capital that they're on the hook for. It's not clear that they do not have to continue to cut the dividend. GE is heavily owned by retail investors, many of them watching your program tonight, and I would just tell them, I do not believe that its dividend is safe and secure. I think based on all of the issues that GE is facing, including, the debt obligations, future cash obligations, and so forth, I do not think this dividend is secure, no.
Okay, very quickly, because I'm really out of time. If you own the stock, do you continue to own it, or do you just sell the stock and put what money you have left from GE into something else?
I think you move on, quite frankly. I think this is going to be many years of work through and work out, and I just think there are better places. GE now today provides sort of a market dividend. I mean, it's really not remarkable versus lots of other options. So no, we would take profit, or I'm sorry, we would just sell the stock.
Sell the stock.
There's probably no profits and move on. Yeah.
Okay. On that note, John, thank you so much.
You're welcome.
John Inch with Deutsche Bank. The head of the world's largest asset management firm has a warning for CEOs. BlackRock's Larry Fink is telling the chief executives of publicly traded companies that they have a social responsibility to their communities, not just a financial one to shareholders. In his annual letter, Fink wrote that companies need to demonstrate a long-term strategy for value creation with an understanding of the company's effect on the world. BlackRock manages more than $6 trillion in assets. Still ahead, the immigration fight deepens as the threat of a government shutdown looms. The cost of BP's Deepwater Horizon spill is increasing. The company is taking a nearly $2 billion charge, bringing total costs from the 2010 Gulf of Mexico disaster to about $63 billion. The well blowout caused the worst offshore oil spill in American history. BP will take the charge in the fourth quarter, which will also see a separate $1.5 billion accounting charge related to the U.S. tax bill. Senate Democrats say they are close to getting the votes they need to reverse the FCC's controversial decision to roll back rules governing the Internet. But even if the resolution were to pass the Senate, it would still need a majority vote in the House and the president's signature. Last month, the FCC struck down rules that prohibit Internet service providers from slowing traffic to certain websites. Also in Washington, there are reports that the former White House chief strategist has been subpoenaed. According to the New York Times, Steve Bannon was subpoenaed last week by special counsel Robert Mueller to testify before a grand jury as part of the Russia investigation. It is believed to be the first time Mueller has used a grand jury to seek information from a member of the president's inner circle. He was reportedly subpoenaed during his closed-door meeting with the House Intelligence Committee. Well, this next sentence probably sounds pretty familiar. We are just days away from a government shutdown. The deadline to reach a deal is Friday, and right now the focus is on two issues: spending caps and immigration. John Harwood joins us tonight from Boston this evening. So, John, why is an immigration deal connected to the government funding deadline?
Well, you'll recall, Sue, that President Trump ordered the ending of the so-called DACA program, protecting those dreamers who came as young people to the United States, have not committed crimes. There are about 800,000 of them. He has directed that to expire at the during the month of March. And what the Democrats are saying is that because President Trump has said he wants to protect those dreamers in a different way than President Obama did, and because it's very popular, they're attaching it, linking it to this spending bill because they have to reauthorize funding for the government by Friday. And so they're establishing that as a condition of their cooperation.
So do you think that they can still reach an agreement? And if they don't, what are the possibilities of a government shutdown?
They can still reach an agreement. We've seen from President Trump that he often reverses field and takes one position one day, another the next day. There is the basis of a bipartisan deal on immigration, although some conservatives in the Republican Party don't like it. But it's gotten harder because of the way the president spoke in that Oval Office meeting we've all been talking about for several days. Now, if they don't reach an agreement, there's a chance we'll have a government shutdown. There's also a chance, though, they'll find a way out with a very short-term extension of government funding to give them more time to work on it.
We will wait and see. Thank you, John. Appreciate it. John Harwood in Boston tonight. Well, it's been nearly a year since Donald Trump was sworn in as president. He told the country that he would help grow the economy. So how's he doing so far? Steve Leisman takes a look.
President Trump looks to have gotten his 3% growth number during his first 3 quarters. The question is how much he's responsible for it and whether the growth can continue. GDP averaged exactly 3% since the second quarter of 2017. That assumes the fourth quarter comes in at the projected 3%. That's an extra 1% of growth compared to the prior 4 quarters. And most of that extra growth has come from investment, including less growth in structures and housing, but more growth in business equipment. One force that could be behind it is increased business confidence from the president's policies, including expected tax cuts and actual deregulation. Higher stock prices could also be generating a wealth effect.
You've gone from an administration that said you didn't build it to an administration that says, how can I help you build it?
But the economy under President Trump has also benefited from higher oil prices, and part of the equipment spending increase looks to be tied to energy. Growth has also been helped by more federal spending, largely from defense. There's also a big boost in inventories and in trade, in part because of the weaker dollar, along with better growth overseas. Job growth has been strong under President Trump, up 1.9 million jobs since February, but a bit less than the comparable 11 months of the Obama administration. Unemployment has plunged to 4.1% from 4.8%. Retail jobs have been depressed in the president's first year, but that continues a trend seen before. Manufacturing jobs, though, have been strong.
The revival in manufacturing goes to the better global economy. The entire global economy is on the same page for the first time since the Great Recession back 10 years ago. It's pretty tough to connect those dots between, economic growth and the president. I mean, there was no major change in economic policy except at the very end of 2017, and that's the deficit finance tax cuts.
So the jury is split. Some see the first year of the Trump economy benefiting from positive reaction in the real economy to his expected and actual policies. Others say these are trends beyond the president's control and influence. Most agree. The true test will come if this kind of growth can continue now that his policies are actually coming into place. For Nightly Business Report, I'm Steve Leisman.
The Energizer bunny buys its rival Rayovac, and that's where we begin tonight's market focus. Energizer has agreed to buy the battery and portable lighting business from Spectrum Brands for $2 billion, adding the Rayovac brand to its portfolio. Energizer shares kept going and going and going, finishing up 14.5% to $59.11, while Spectrum added just about 4% to $125.23. Citigroup posted its biggest quarterly loss ever as a $22 billion charge related to the new tax law erased the bank's profits. The loss was largely due to accounting changes the bank had to make in order to be compliant under the new legislation. If you take out the charge, Citi beat expectations, so shares were up a fraction to $77.11. AutoNation said it would use the savings from the new tax plan to bolster its retirement and health benefits for employees. The nation's largest auto retailer said it would also see a one-time benefit of 45 cents a share for the current quarter and an 80-cent benefit for full-year earnings. AutoNation shares were off more than 1% to $57.24. After the bell, the railroad operator CSX reported stronger than expected earnings, but said a drop in shipments caused revenue to disappoint. The results come just 1 month after CSX chief executive died while in the midst of a company turnaround. CSX initially fell after hours, adding to nearly 2% losses in the regular session, where shares closed at about $58.13. Also after the bell, Boeing said it was launching a company with automotive seats maker Adient to create airplane seats. Boeing said it would have a minority stake in the newly formed joint venture called Adient Aerospace. Boeing shares initially fell fractionally in the after hours. They ended the regular day down just slightly to $335.16. Adient shares initially plunged in the extended session and ended the day down marginally to $82.18. Nestle is selling its U.S. confectionery business to Italy's Ferrero for nearly $3 billion. The U.S. unit, which makes things like Butterfinger and Crunch bars, has been underperforming its rivals for years as consumers gravitate to more healthy food choices. For Ferrero, the purchase is a chance to scale up quickly in the U.S. market, which is a top priority for that company. Coming up, the future of driving.
Here's something you don't see every day. The whole side of the car opens up. Innovation brought to us by a Chinese auto company. And they want to sell cars in the United States. I'm Phil LeBeau. That story coming up on Nightly Business Report.
Here's a look at what to watch for tomorrow. Goldman Sachs and Bank of America are scheduled to report earnings and give guidance on how their financials will be impacted by tax changes. The Senate will hold its second and final vote for Fed Chair nominee Jerome Powell. And the Fed will release its Beige Book, which is an anecdotal look at economic conditions across the country. That's what to watch for on Wednesday. The price of Bitcoin fell below $12,000 for the first time in more than a month. That drop came after South Korea's finance minister reportedly said the shutdown of virtual currency exchanges is still an option. South Korea is one of the largest markets for digital currency trading. There are also separate reports of an escalated crackdown on the cryptocurrency market in China. Global car makers are pouring money into electric vehicles. Together, investments total $90 billion. And according to analysis by Reuters, that number is expected to grow. The world's top automakers are expected to introduce new types of battery-powered vehicles, as well as hybrid cars over the next few years, many of them in China. General Motors, meanwhile, expects profit growth to stall this year. Following 5 years of increased earnings, the automaker said results in 2018 will be in line with last year's. GM says pricing pressure in the U.S. and China will impact its results. But the company is forecasting higher profits in 2019 with a revamped lineup of pickups hitting the U.S. market. And late today, its rival, Ford, issued disappointing profit guidance. That automaker said higher commodity costs are offsetting gains from continued demand for its pickup trucks. This year's Detroit Auto Show is highlighting an industry at a crossroads. Sales are strong, but growing questions about NAFTA and America's appetite for trucks and SUVs have some questioning how long the good times will last. Phil LeBeau is in the Motor City.
Riding a wave of demand for bigger vehicles, automakers are rolling out a slew of redesigned SUVs, like the Jeep Cherokee, and pickups including the Ram 1500 and Chevy Silverado.
It's been a huge couple of truck years, and we anticipate another big truck year, and you've got to keep up to date.
Ford, which underestimated the appeal of mid-size pickups, is now trying to catch up to competitors with the new Ranger pickup.
The F-150 is doing really well. That franchise is great. And this proves to us with this mid-size category that we need to be there. And so a lot of what we've learned has come back with the Ranger. We've got a good franchise around the world, but having it here in the U.S. is really important.
Hovering over automakers is the question of what happens to NAFTA and the vehicles they import from plants in Mexico and Canada. President Trump is threatening to rip up the agreement and tax vehicles and auto parts coming from north and south of the border, a move that could have huge consequences.
The consumer, in the absence of a realignment of production facilities, will pay a price. It is not insignificant.
As cost goes up, demand typically goes down. It's simple economics, and that's risk to employment here in the U.S.
Despite the NAFTA questions, the U.S. market is expected to remain strong and lucrative. So lucrative, China-based GAC Motor is planning to sell cars here starting next year. If GAC can deliver on its promise, it will become the first Chinese auto brand sold here in the United States. Phil LeBeau, Nightly Business Report, Detroit.
Before we go, here's another look at Wall Street's big reversal. After the Dow surged past 26,000, the rally lost steam. And by the close, the Dow lost 10 points, the Nasdaq was off 37, and the S&P 500 dropped 9. On that note, that will do it for us tonight. I'm Sue Herrera. Thanks for joining us. We'll see you right back here tomorrow.